Hi guys, in this video I'm going to be talking about what I learned from listening to more than 500 hours of investing podcast. First of all, I just wanted to mention why I did listen to 500 hours of podcast. I commute a lot. My work involves a lot of traveling. So whenever I used to go to my office and come back to the office as well as go to other locations, I am into sales, so I do have to visit a lot of retail outlets. So I used to listen to a lot of investing podcasts, and I had a lot of time while driving. I didn't have anything better to do, and I wanted to get better at investing since I did have a lot of cash, a lot of savings, and I thought, let me look into investing. So I could have chosen the easy route and could have just invested in index funds and averaged around 9 to 10% annually. But I was looking for much better returns, and I thought, hey, let me do some active investing and see if I can outperform the index funds. So most of my investing podcasts that I listen to, they concentrated on macro investing. Some of them were value investors, and a few of them were growth investors. And I've been listening to these podcasts since 2018, and some of them are quite famous in the financial industry. Well, it's obvious you guys already know, but the growth investors have outperformed value investors by a mile. Why did I listen to macro investors? I just wanted to. I always found how the economy works interesting, and I thought, hey, these macro investors, they look at the economy of the United States, they look at the economy of other countries, and they probably see what's coming way ahead of other investors. So I thought, hey, let me listen to most of these macro investors. So first, I'm going to be talking about macro investors and what I learned from these podcasters. Most of these macro investors are quite bearish the stock market, and they have been bearish since I've started listening to them since 2018. They believe that the Federal Reserve of the United States is propping the stock market, and once there will be a point in the future where they will have to increase the interest rates because of inflation coming. So far, they have not been proven right. It might take some more time, but once the inflation comes, they believe that the Federal Reserve will have to increase the interest rates, which will reduce the price to earning ratio for all these companies, since they've been they've been taking a lot of debt, and they've been investing through that debt, or they've been increasing their market share through that debt by taking loans and investing in companies, or buying cheap assets, and doing a lot of things which is much easier to do in a negative or in a zero interest rate environment than when the interest rate is higher. So when the interest rate is higher, usually the value stocks perform really well. But so far, as you can tell, the Federal Reserve of the United States, or all the central banks, are lowering rates because of the enormous debt, and because, of course, of the pandemic recently. Then the second type of investors that I listen to are growth investors. Most of these growth investors believe that the economy will do well, and most of them are technology oriented. They believe in the future of technology, and they've done amazing. So anyone who's been invested in stocks or companies such as Amazon, Google, Microsoft, Netflix, the FANGs basically, even the cloud companies like MongoDB, CrowdStrike, even cybersecurity stocks. You just look at the ETFs, you're going to see they've done really well. Even a company like Tesla, it's a growth stock, EV industry, right? They're a disruptor. Tesla has outperformed any value stock you can compare to. So they've done really well. Then the third investor or the third podcast where I was listening to were value investors. So these investors or these podcasters, they believe that some of these stocks are cheap, and they look at the financial statements, they look at the balance sheets, and they believe that the market will re-rate these stocks because they're so cheap, or eventually there will be a point where their earnings will be much better than it is right now. Unfortunately, even though some of these value stocks have done better, but in comparison to in comparison to these tech stocks, they have not. They've always been catching up. In these value investor, there are some investors who are invested in deep value sectors. By deep value sectors, I mean sectors which have been like they have not had any interest by the investing community or by any hedge fund. So, like the coal industry, if you look at any of the stocks which are in the coal industry, they've had a really bad return. In fact, if let's say you were invested since 2018, you would probably be down 50% in a coal company like Peabody. One of the company's name is Peabody. There's a lot of coal stocks. Then let's say uranium. Since 2018, I was listening to one podcaster who runs a uranium hedge fund, and he's been saying that the price of uranium has to go up because these miners, they can't make money right now. Right now the spot price is $32, I believe, and they need the spot price at least to be around $55 to $60 in order for them to make money. But still, the stock price hasn't shown up because the people who are supposed to buy these uranium from these mining companies, which are the utilities, the nuclear power companies, they still haven't come into the market. Many thought they would be coming in 2019. Then they thought they would be coming in 2020, but now because of the pandemic, it seems like they might be coming back in 21. So that's another example. Then there's the shipping industry, which has been beaten down to death. Like if you look at the graph, it's all minus 30%, minus 40%. They thought that there will be a catalyst called IMO 2020. I won't get into specifics, but all these sectors have not performed close to the technology industry. So let's say if you were invested in these deep value or value stocks, you would be down maybe 15 to 20%, and if you were invested in only tech stocks, you would be probably be getting 30+% on average, or more, even more if you were just invested in FANG stocks. So Facebook, Amazon, Netflix, Google, Microsoft, they've just killed it past few years. So in my next video, I'm going to be talking about what I think personally, which companies or which sector, which type of investing will outperform the market. So just if you found this video interesting, or if you found this video interesting, just give me a like and subscribe to my channel, because I'll be posting a lot more stuff in the coming weeks. Thank you.